SN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
You are listening to the Financial Survival Network. I'm Kerry Lutz. Coming up shortly is John Rubino of dollarcollapse.com for our usual Monday morning get-together. This episode is brought to you by Borderless Holdings, formerly known as Owings Metals. Don't forget wearable wealth. Right now, with precious metals prices bottoming by virtually any measure, any technical measure of the market, and I do believe they are bottoming. I mean, it's a virtual certainty. Look at Charles Nenner, look at Bob Hoy, two cycle researchers that I really do trust. They're bottoming. I mean, a virtual certainty. I've been wrong out of the last 12 predictions of the market's bottoming. I've been wrong 12 times, so if you listen to me, you're going to lose money, but this time it's looking pretty sure because of the time of the year. Nenner says July is the time. Hoy says they're already bottoming. Nenner says that silver has already bottomed. I think so. Now silver is back over $19 the ounce. But anyway, Borderless Holdings, call them up, talk to Seth. I saw Seth. He was down here in Florida over the weekend. Call them up at 855-604-6343, 855-604-6343. Tell them Kerry sent you. Don't forget, follow us on Facebook. Just look for Financial Survival Network. And, Twitter. Don't forget, we're tweeting kind of regularly now. So at Kerry Lutz. And if you don't want to go looking for our links wherever or on the site at financialsurvivalnetwork.com, just go over to iTunes, the iTunes store, type in Financial Survival Network. You can automatically get the show delivered to your iTunes program if you're on the Mac or the PC or any other platform that takes iTunes. Just go there and get it. So that's that, and there's just a lot of things happening we're going to be covering today. It's just remarkable the things that are going on out there. I mean, California, more adult Californians moving in with their parents. We talked about that. Hundreds of thousands of people. 2.3 million adult Californians were still residing in their parents' homes. Probably half those people have passed away and they're collecting their Social Security. I mean, it's nuts. Detroit, they're going to spend $850 million to tear down 40,000 homes at a price of $22,000 per home. You or I could definitely do it cheaper, but they need union help to do it. I'm sure of that. Like I say, up next, you'll be hearing from myself and John Rubino. So, John, we've got John Rubino with us, and it's Welcome to the Currency War, Part 16. Interest rates go negative. We got the news last week from Draghi. So now the banks are not just doing you a favor, taking your money, but they're charging you to keep your money on deposit. So if you got $10,000, just go take the money out in cash and put it in your mattress, and you're going to be better off, right, John?
Hey, Kerry. Yeah, last week's big news was the European Central Bank beginning to charge commercial banks that deposit money with them. And the idea, this doesn't apply to your bank account in Europe yet. Mm-hmm. You still get a fractional minimal interest rate if you deposit money. But the idea is that the trend is in that direction, that eventually, because everything they're trying hasn't really worked in Europe especially, and that eventually the big banks are going to have to start charging you interest for deposits. And at that point, that kind of flips the whole saving and investing calculus on its head, and things will change dramatically. And this is the first step in that direction. So what's happening now is that with the European Central Bank charging for commercial bank deposits, the idea is that the incentive for a commercial bank now is not to just park money with the central bank and keep it safe but don't earn much on it. Now you're charged for that privilege. So the incentive is to lend money to businesses or to consumers or whatever, and get a much higher yield by lending to them, although you have to take on more risk. And that's what the central banks of the world want now. They want commercial banks to start lending. They want businesses and consumers to start borrowing. And in that way, they hope pump up the economy.
Okay.
But of course, it also means people are taking on a lot of risk. If there were good lending opportunities out there right now, then a lot more loans would be written. But the fact is that most businesses and individuals in Europe really aren't very good credit risks. And most big banks in Europe are already saddled with a lot of bad paper. And they have really no desire to create more potentially bad paper by lending to people who aren't necessarily in the best shape. But the only way the people in charge of the global economy can see to generate growth now is to get lending pumped up, even if it's bad loans, even if it's to mortgages to people who can't really afford them, or business loans to businesses who aren't seeing rising sales, or consumer loans to people who already have too much debt. They don't care anymore. They just want lending and borrowing to happen. And that's what this policy initiative is about.
So in the U.S. Right now, there's excess reserves on deposit with the Federal Reserve. It's something like $2 trillion the banks have on deposit with the Federal Reserve right now, and they're getting 25 basis points for doing it. So what would happen if the Federal Reserve, if Janet Yellen follows the example of Draghi, then we would have a lending orgy around the world? Is that what's going to happen?
Well, the U.S. is somewhat of a different story. Doug Noland over at Prudent Bear publishes quarterly his analysis of the Fed's Z1 report, which is their compilation of all the credit market activity in the previous quarter. And it looks like from that report that the U.S. credit bubble is back in high gear. To take just a few snippets from what Doug published last time, total credit market debt in the U.S. Jumped to $59 trillion in the previous quarter, which is an all-time record, and almost 350% of GDP. That's a huge number. That's bigger than before the last crisis. And corporate borrowings grew by 9%. It's almost double-digit rates. The corporations are taking on new debt now. And the federal government continued to borrow. Its debt was up 7%. Consumer debt rose 6.6%. And so basically across the board now, we're seeing an increase in borrowing in the U.S. So we are back in a lot of ways to 2007, where you're seeing stock markets across the board hit new records, margin debt hit new records, and the implication being that people are borrowing aggressively against their stocks to buy new stocks. And housing hasn't rolled over yet. It's kind of plateauing, but it's still at higher price levels in some markets than in 2007. And consumer debt, especially for cars, is soaring in the U.S. So we are back to creating another credit bubble. And so the question now becomes, can we keep this up? Can we continue to take on more debt past all the previous records, which coincided with huge market crises in 2000 and 2007 and 8, or are we going to see another crisis in the short run because of all this? And I would argue that it's kind of guarantees another crisis, but not the timing of another crisis, because we seem to be able to keep interest rates at artificially, extremely, historically crazy low levels without huge consequence yet. And as long as we're able to force rates down and make everybody think that borrowing is a good thing because, well, if you can get money for 3%, you must be creditworthy. You must be doing okay because the banks think you're doing okay. And for the banks to think, well, if that home is going up in value, maybe I'll lend against it. And even if the borrower gets into trouble, I'll be able to sell the house for more money later. That kind of thinking takes hold during credit bubbles. And we're starting to see that again in the U.S. So we're seeing kind of an imbalance now around the world, where China is slowing down because they had their credit bubble over the last 5 years, and now they're starting to see a huge amount of bad debt start to bubble up, and they just had the rehypothecation issue with a lot of metals trading, where it turns out that iron and aluminum, things like that are in their warehouses are owned by several people now, and they can't figure out who actually owns it. And so that part of their economy is starting to freeze up as they try to figure out who owns what.
Sounds like what they do with COMEX here in precious metals, right?
Yes, it does. It's a fractional reserve system in a lot of the metals markets, in which an increase in physical demand could lead to a default and could just freeze up the system because nobody will know what they really own anymore. And you're seeing that in China with their industrial metals trading industries. And meanwhile, in Europe, things are slowing down dramatically. The bank lending is kind of moribund, and price levels are starting to drop into deflation. And so they're finding it necessary to join the quantitative easing party. And the stuff that they've announced now didn't really excite the markets very much. They were kind of half measures, a slight dip into negative interest rates on bank reserves and a small increase in bond buying. And that's not enough. It hasn't really caused the euro to tank, which is what they need versus the dollar. And it didn't really excite the overall financial markets. So what they'll have to do is something more extreme in the not too distant future. And what they're talking about doing is buying asset-backed bonds. In other words, a bank writes a mortgage and then takes that mortgage and bundles it with a bunch of other mortgages into a bond package and then issues those bonds to institutional investors. Well, the European Central Bank is going to start buying those bonds as a way of funneling money.
I've heard of that before.
Doesn't that sound familiar?
Let's talk about that when we return on the Financial Survival Network.
FSN Radio.
Do you have Medicare or health insurance through your employer? If so, listen up. The healthcare reform wasn't written to save the healthcare industry or even to lower healthcare costs. Shoot, it isn't even designed to insure the uninsured. It's just a temporary political byproduct. Like a flat rock you step on in a swiftly moving stream, Obamacare is just a means to an end. Want to learn more about Obama's ultimate objective? Then you'll want to review our latest research presentation found on oclies.com. In it, a health expert and industry insider explains what you think you know about caring for your health is about to drastically change in 2014. Plus, he details the simple steps you could take to save thousands of dollars per year in health costs. It's free for you to preview at oclies.com. Don't waste time. What you don't know about the healthcare reform could hurt you and your family.
The Financial Survival Network. It's all about what's next.
We're back. We're speaking with John Rubino of dollarcollapse.com. John, this sounds vaguely familiar, like a book I once read called The Money Bubble, doesn't it?
Yes. It's very similar to what happened to the U.S. in the early part of the previous decade, when we just cut interest rates to the bone and pumped up the securitization market so that banks were making loans that they didn't care about, whether the loans were any good or not, because they were going to package them and sell them off to gullible institutional investors.
Does anybody learn anything in this world anymore from history? Or
No.
Does history, is it a total irrelevancy that can't happen to us? We don't care. Don't worry about it because there's always a bigger, better bailout. Just fail better and bigger, and they have to bail you out.
Yeah, that does seem to be the thought process, because these guys who are in the credit markets right now, most of them are old enough to remember 5 years ago, right? It's not like the Great Depression or anything.
They weren't in diapers then, were they? 5 years ago?
They were at least in business school. They were at least reading the paper and paying attention to this. And most of them actually lived through the process. And yet here they are again, pumping up the securitization market and creating questionable loans, packaging them into questionable bonds and selling them off to institutions who should have some kind of an institutional memory. They should remember this and they should know better. And no, because for a year or two, this kind of stuff tends to work. And for a lot of these guys, a year or two is enough, because you can, if you make a lot of money in the financial markets, in 1 or 2 years, you can make enough money to retire rich forever. You make a $2 million bonus 1 year, and that's basically enough if you bank most of it. You can saunter off into the sunset and be fine and leave the problem for your successors. And so
it's really distressing. It's like people, they're really sociopaths.
Yeah.
They have no regard whatsoever for the long-term ramifications of the actions that they're taking.
Yeah. I mean, they're so short-sighted that they're functionally sociopaths, even if they are actually nice people who just aren't paying attention, So you really have a mix on Wall Street of people who are basically psychopaths all the way out to people who are nice but clueless. Throw them all together and you get the markets that we have today. And one of the really interesting things about this process, especially of pumping up asset-backed markets, is that a lot of the lending really doesn't go to productive assets. For instance, a house is not a productive asset. It's not an investment, no matter what your realtor tells you. It's actually a capital destruction mechanism. Anybody who's owned a house.
It's a consumer item.
It is, because you buy a house and then you have to maintain it and you have to pay taxes on it, and all that cash just disappears, right? It doesn't make the house more valuable, and it doesn't allow you to produce more. It's not like a factory that once you build it, you can make stuff that people want. It's, as you said, a consumer item. It's something that you use, and maybe it improves your life at the margin. But in a lot of cases, a big house doesn't really improve your life over a condo or something like that. It actually complicates your life. But you think you have to have one. The system tells you should have one and gives you cheap financing and makes it easy to borrow and to buy one. But it doesn't improve your life. It doesn't make you more productive.
It doesn't build wealth.
No, it doesn't make society more productive in any way. So to the extent that we're convincing people to borrow, to buy houses and cars, and that pumps the economy up in the short run, it doesn't pump the economy up. It doesn't improve our future prospects in any way. And so to the extent that that's government policy, to get us to borrow, to buy non-productive assets, means that we're basically consuming future wealth today and pumping up GDP and tax revenues in the short run and making things look far better than they really are. And to the extent that economists who should know better and government bureaucrats who have been around the block a few times are actively engaged in this kind of policy is really shocking. If we were actively trying to subsidize factories, actual productive assets, that would be one thing. But we're trying to subsidize consumer spending that produces really nothing of value in the short run.
Exactly. I mean, that's what it comes down to. I mean, you got maybe you got 30, 40 guys working on a house, and you sell some copper, concrete, wood, and all that stuff. But it's not, once the house is finished, then it's on to the next one, right? It really doesn't build wealth. It's not a wealth generator. Once you're in your house, then you first start spending money. But the debt goes on. The debt still exists, and it increases that side of our balance sheet. But the productive asset side of the equation does not rise, and so we're just creating this bigger and bigger debt overhang that we couldn't cover in 2007. We couldn't cover in 2000. We didn't have the money then, and we don't have any extra money now. Incomes haven't gone up. Paper wealth has gone way up. But it's mostly financial assets. It's mostly the stock market and the bond market. So let those things correct as they do periodically. And all this new household net worth will just evaporate, as it always does in downturns. So we're creating a more and more unstable society. This is the Austrian economics analysis of how a system goes from of hedged financial activity to Ponzi finance. Perfectly. It's right out of the textbook. And let's go over to China and carry this over here, John, because I think it's important to look at how it works for China too, because they're just reacting. They're just giving us the crap that we want, right? That they think we want. that we've been conditioned to want. So they're just reacting to all these export markets that have been conditioned and manipulated by central banks, right? They don't have a market of their own. They're just exporting to meet the needs of these markets so that the manufactured money can go further, right? So Walmart can sell more crap. Right?
Yeah, basically, we in the U.S. engineered a consumer-driven society in which we convinced regular people to borrow as much money as possible to buy crap, whether it was a house or a new car or toys or clothes or vacations, stuff we didn't really need.
To put it scientifically, to buy flat screen TVs, to finance them, right?
Yeah. And I love my big screen TV, but it's not something you borrow to buy. No. All right. It's something you save up a little bit each month for a year or two, and then you go out and you reward yourself for saving by buying something that you really want. You don't put it on a credit card.
No.
But that's what they encouraged us to do. And so China,
you get interest-free financing on it, right?
Yeah. Teaser rate. It's a teaser rate world now. Yeah. But China geared up to supply all this crap to the U.S. Mm-hmm. And so now they have factories everywhere you look. And when we had our crisis in 2009 and consumer spending started to slow down, China embarked on a debt binge of its own to build infrastructure domestically. They built roads and bridges and whole cities without any real thought to whether those things were actually going to see enough use to generate enough cash flow to pay back the debt that was required to build them. And now it turns out that a lot of those places aren't generating that kind of cash flow. And so China took on $15 trillion or so of debt that is not seeing the kind of return that they need. And so they've got a credit crisis of their own going here. Uh-huh. And so we could bail them out by pumping up our consumer sector now and having another borrowing binge where people just keep on buying toys and clothes and taking vacations and all the stuff that we don't need but that we used to borrow for. If we start doing that again, that possibly bails China out in the short run. But
they'll get more worthless dollars and more worthless T-bills, right?
Yes. Yeah. Well, more in the future worthless stuff. Right now, China, on the plus side, China is using a lot of their dollars to buy real assets around the world. They're the biggest investor in Africa. They're buying African natural resources at an accelerating rate, and they're the biggest consumer of gold now. They're importing 100 or so tons of gold per month, which is a huge number in the scheme of things. And so, they're converting a lot of their dollars into real stuff, which is smart, which is a good thing. And against that, they've got this credit bubble that's blowing up now. So who knows how China plays out, because we've got these big contending forces right now. Some stupid ideas that are blowing up versus some good ideas that should pay dividends in the future. And I don't know. I don't know whether China comes through this unscathed or they have a huge credit crisis in the future. It's more clear that the U.S. and Europe and Japan have just been pretty much stupid across the board. We're shipping our gold to China. We're increasing the amount of currency in the market, and we're encouraging our consumers to go into debt to buy stuff they don't need. So our problems are more clear-cut and more likely to cause a gigantic crisis out there sometime in the not-too-distant future.
And let's talk more about it when that crisis happens, where all the rats are going to run to, when we return on the Financial Survival Network.
FSN Radio. It's all about what's next.
When your accountant wants tax-free income, this is what he does. Accountants know the law. They also know that any American could legally get paid up to 3 times per month, 100% tax-free. That's 36 tax-free checks each year. It doesn't matter what you make already. This simple strategy could work for anyone. Go to www.irsrevenge2.com to learn how. That's irsrevenge2.com.
The Financial Survival Network. It's all about what's next.
And we've returned on the Financial Survival Network. We're talking to John Rubino of dollarcollapse.com. This is addressed in the money bubble, but something like 65% of China's economy is export driven. All right, you can make the argument that, a lot of it now is going to Asia, but still, the EU is going to fall. The U.S., a lot of Canada and Australia, a lot of their markets are just not going to be there, John, when this money bubble blows up, and a lot of Asia is not going to be there. And, world trade is going to crater. And where is that going to leave China? That's what I'd like to know, because people say, well, people are going to start buying in China. It's going to, the economy there is going to take off. And I just don't see it, because, their economy is basically, people there save like half their money because they know there's no safety net. And I think that's a good thing, that there isn't a safety net, because the safety net has made people really weak and really, non-self-sufficient. It's really become a big problem. And, what's going to happen to the world,
Yeah, well, that's China's dilemma right now. They basically hitched their star to the U.S. consumer. And it worked beautifully for them for a long time, but the U.S. consumers are tapped out. We have bought as much as we can really buy.
We got storage lockers full of this crap, right?
Yeah, that's a growth business.
Yeah,
the storage business, because our 3,000 square foot houses can't hold all our stuff anymore. Yeah. So we've got to do something with our extra stuff. And garage sales too. So storage business and garage sales, growth industries in the U.S. along with debt collection. But so China has this dilemma. They have a high-powered export sector that is aimed at a market, the U.S., which probably can't continue to buy at past rates. And so what China has been doing in the last few years is trying to convert its economy to domestically consumption-driven from export-driven by building a lot of infrastructure and creating jobs domestically, which hopefully would allow its own people to buy the stuff that's produced by its factories, and in that way wean itself off of the U.S. And that's a tough transition, because as you said, Chinese citizens have longer memories than U.S.
Lucky
consumers.
For them.
Yeah, and so they tend to save money because they know that the next crisis is just around the corner based on their cultural history. And so they tend to buy a lot of gold. If you turn Chinese consumers loose with a lot of money, they will go to the jewelry store and they'll buy a lot of gold chains and other kinds of jewelry, and they'll also buy gold coins and other kinds of precious metals. And that's great, because it means that Chinese citizens are accumulating real money in an era when real money is going to become much more valuable in the future. But it doesn't help Chinese factories that are trying to build toys and clothes and other little doodads that nobody really needs, but excited, optimistic people tend to buy. And so we'll see if they can make the transition. I don't know. There are cultural barriers to it, but there's also a huge amount of money in China right now that can be directed to stuff like that. So I really don't have any deep insight into whether China's going to be able to make this transition seamlessly, or whether they have to go through a big crisis on the way, or whether it's impossible for them to get there and they just have a huge existential crisis in which their old model doesn't work, but the new one proves untenable, and they tank like a lot of developing countries do when they try to transition from one model to another. So I don't know. We'll see. But I think it's in part dependent on the U.S. Mm-hmm. And I think that we are reaching the end of the rope where we just can't borrow that much more money and make it work. And yet we're trying to. This year, the crucial story in the U.S. is the credit bubble is back, and our borrowing is starting to spike again. And a lot of the borrowing is by corporations. And a lot of that borrowing is companies buying back their stock with borrowed money, and in that way pumping up the stock market. So that's another unsustainable trend that we've seen in the past, and that always leads to a big correction, because corporations run out of borrowing room. Mm-hmm. And they have to stop borrowing to buy back their stock, and that knocks the underpinning out of the stock market, because individuals aren't buying equities at the rates that they used to. And unless the government is going to step in and start buying equities directly, you take the corporation out of the equation and the stocks go down. So we might see in the future in the U.S. Companies doing fewer and fewer buybacks, and the government feeling compelled to step in.
Or making,
And
they're making these acquisitions are taking place also,
yeah,
which probably make no sense, a lot of them. But, right, that hasn't stopped them before
well,
either, right?
they have the cash. They have to do something with the cash. And when you're in charge of a big company and you have a chance to get way bigger, it's pretty tempting, because building empires is just a very cool thing to do. That's got to be one of the most fun things to do in the business world, when you have other people's money and you can use it to buy out a competitor,
Yeah.
and just kick out the guy who used to be your rival there and take his company. That's a pretty tempting thing to do. And we've seen that cycle repeat a few times.
It's good to be the king, right? Yeah. It's good to be the king.
Yeah, guys, your age and my age can more or less remember the junk bond era, in which that was the big activity. You borrowed money via junk bonds, and you went and you bought out everybody else in sight, and you built this big empire, and people were talking about you as the next Bill Gates or the next Warren Buffett. And I remember the guy who ran Fruit of the Loom, which was an underwear company. They were borrowing money like crazy and buying up all kinds of competitors, and people were talking about him as this corporate genius, and maybe he should run for president and everything.
Yeah, what was his name? Fromkin or something like that.
I don't remember his name, but I do remember people talking about him running for president. And he ran an underwear company, and Wall Street was giving him extra money, and he was and so stuff like that happens when you have too much money, really, and not enough sense.
Yeah.
Too many dollars, not enough sense. And you get stuff like that. And we're starting to see that now. It's mostly in the realm of corporate stock buybacks at the moment, which is also a great thing if you're the CEO, because your income, your bonus at the end of the year is based on the stock price during the year. So if you can borrow money and buy your stock back and pump up the stock price, and nobody else is really paying attention to this, it looks like you're a genius. It looks like you're a great manager because your stock price is going up, and they pay you a lot of money at the end of the year. But really, all you did was leverage your company in order to pump up your year-end bonus.
And you might have some economies of scale there, right? You could have some initially that wear off pretty quickly, like when the banks consolidated, and you can get rid of all these thousands of so-called redundant workers, and you look really smart, but you didn't really do anything that great.
Yeah, economies of scale from major acquisitions are kind of a myth, actually. They don't seem to work, because it's just not that easy to meld, a $20 billion company with an $18 billion company and come out with something that's worth more than $40 billion. That's a gargantuan task, and it usually doesn't turn out to work. You look at JP Chase. They're the result of 5 or 6 other really big banks all being merged together.
Chemical
Bank,
and
Chase,
JP Morgan, and
was it Wachovia? Did they buy Wachovia? I don't remember who.
Or Washington.
Yeah.
What was that? Washington Mutual.
Yeah.
They got them. Some of them they didn't even want. They just were thrown to them during the financial crisis. But the whole purpose of the Federal Reserve was to only wind up with a few banks, right?
Yeah, well, it seems that way. That was the result, and the end result of that process is that you've got a lot of big companies that are able to kind of game the market because they have political power. So they're able to operate in the regulatory realm very profitably, where they go in and they lobby with a few $1 million, a bunch of congressmen and regulators, and they get a law passed that protects them to an extent and is worth billions of dollars to them at the expense of their smaller rivals. You do end up with a certain economy of scale when it comes to buying government largesse. But in the end, it always blows up on you, because gigantic companies, past a certain point, big companies just aren't nimble enough to really operate effectively. So you'll see something come along that does to JP Chase what Google did to the other big tech companies. Like Microsoft was considered a danger to run the entire world at one point. They were the big target of the antitrust guys.
Sure.
And then Google comes along, and Apple comes along, and a few other companies, and all of a sudden Microsoft isn't also ran. Well, that will happen to the big banks because of Bitcoin or precious metals or something else where people decide that this is a more attractive market, and all of a sudden the big banks aren't involved in it, and they're on the sidelines watching all this growth and shrinking and trying to deal with all the pathologies of too much debt and too little sales. And that'll happen. That always happens.
Yeah.
But in the short run, yeah, and a lot of
on that note, we are through, but you find John at dollarcollapse.com, and don't forget to go out and get his book, The Money Bubble. And of course, you'll find the link on our site, financialsurvivalnetwork.com. And John, we will talk to you next week.
Great, Kerry. Look forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.